Welcome to the CPS Growth Institute podcast, where we explore smart strategies for building long-term financial security. Today, we have a very special episode inspired by the experience and wisdom of a seasoned investment professional. We'll talk about building a balanced portfolio, managing risk, and how adversity can shape resilient, thoughtful investors.
I think of my portfolio in three parts. 1/3 is for planting seeds, those early stage ideas or undervalued assets with long-term potential. Another third is for nurturing investments that are actively growing and need attention to thrive. The final third is for harvesting, where I start realizing gains and locking in returns. For me, it's all about balance, timing, and disciplined execution.
That's such a strong mental model. Investing isn't just about chasing returns, it's about pacing and perspective.
My parents came to the US after surviving concentration camps. They had very little, barely a high school education, no English, no careers. But they had resilience, perseverance, and a love of learning. When I lost them young, my mom at 11, my dad at 17, their lessons became my compass.
That must have shaped your thinking not just personally, but financially too.
It did. I had to start working early, saving every penny. My dad left me a few hundred shares, AT&T, Exxon, and that taught me the importance of income, principal preservation, and long-term thinking. I began my investment career as an economist at a farm lending institution during a major agricultural crisis. High rates, falling commodity prices, it was tough. I helped design a hedging program to manage interest rate risks, which led me into trading and eventually portfolio management.
So distress gave you opportunity.
Exactly. Later, I joined CalPERS just after the 1987 crash. My first task? Analyze portfolios that had underperformed, loaded with complex securities no one understood. That led me to manage convertible securities and ultimately build a career rooted in careful evaluation and value seeking. Those early years taught me the value of discipline. I needed income and low volatility, same things I look for today. Watching my dad record dividend checks in his notebook taught me that income can be a foundation, not just a result.
And you've built a philosophy around that.
Yes, income matters, safety matters, and so does knowing your limits. Risk has to be managed, not just accepted. A colleague once handed me a ceramic piggy bank and said, "You're ready." I wasn't sure, but she believed in me. That pig became a reminder to take risks, accept challenges, and to see potential in others even before they see it in themselves.
And you've paid that forward.
I try, because mentorship and belief can change careers. My portfolio is barbelled on one side, stable income generators like cyclical stocks in low cycles or cash-rich companies. On the other, selective growth opportunities. Then I hedge to protect from major downside. Diversification keeps you from losing too much from one mistake.
And you keep that third/third/third structure alive?
Absolutely. It helps me stay focused. What am I growing? What am I protecting? What am I harvesting? If a stock's yield falls below half the index average, it probably doesn't belong in my income fund. Or if a turnaround story succeeds and triples, I ask, is this still the same company I bought? Hubris in management is also a red flag CEOs who say, I more than we, or care too much about who owns their shares.
You want focus on running the business, not pandering to shareholders.
Exactly. I tell them, use a blank sheet of paper. Reevaluate the stock. Would you buy it again? If yes, explain the plan. If no, own the mistake and move on. Be transparent. Stay present. That's how you build trust and longevity.
Mistakes happen. It's about how you respond.
As an economist by training, I'm a bit more macro-aware. Many income-generating stocks are cyclical, so timing matters. But I also diversify. I don't want my entire portfolio leaning one way. I want safety and spice, steady earners and turnaround bets.
Smart hedging, smart construction.
Outside the US, yields are higher. There are 800 plus companies internationally yielding over 3%, compared to just 150 in the US. While growth has lagged, we're starting to see change. So I'm cautiously optimistic and expanding globally.
Global diversification is coming back in style.
My worst mistakes? Investing outside my comfort zone in assets I didn't understand or that didn't fit my style. I get scared out too early. Know your personality. Know your swim lane. Stay there.
Let others chase moonshots. You build steady wealth.
My edge is equanimity, staying calm, disciplined. I try not to chase fads or panic sell. If something drops, I reassess. A white sheet of paper. No emotional baggage.
It's what makes you such a resilient investor.
Mentors like Janet McKinley and George Miller taught me to stay true to the income strategy, support analysts, and avoid fads. When tech was booming in the late 90s, Janet stayed committed to income. Her integrity saved the fund when the bubble burst.
Conviction matters, especially when it's out of favor.
Stay balanced. Invest in your career, your family, and yourself. Burnout doesn't build wealth. Health and relationships are part of financial security.
Such a holistic message. True growth comes from harmony. Last question, what are you grateful for?
I'm grateful for my husband, my family, my mentors, and for the culture that values support, not sharp elbows. That balance allowed me to build a life, not just a portfolio. Host, thank you for joining us. For more insights on growing and securing your money, follow the CPS Growth Institute podcast. Until next time, invest with purpose, patience, and perspective.